Only kidding. So yesterday we covered a lot of ground, right? We covered what it means to buy low and sell high, which is a very important topic, of course. And then we started getting into the way in which you do it. And so it all begins with market direction, as you learned. Market direction is the key to making money in the stock market. It's also the key to protecting profits. So we're going to start to get into that subject today, knowing when to sell. But yesterday, not only did we cover buying low, selling high, we covered when to buy and then what to buy. And it's cool when you think about the product and the scope that the product has, and that it can really cater to any investor or trader. It's so diverse in what it can do that it can accommodate any kind of technique or trading temperament, if you will. But today, our primary focus is going to be first in finishing out the systematic approach, which is knowing when to sell. That's going to be the main theme this morning. And then this afternoon, what we plan to do is repackage everything from a philosophical standpoint, talk about how to put it all together in terms of when to buy, what to buy, and when to sell. And then we plan to show you how to automate it. And for many of you, that may be the best thing you could do, because it takes all the emotion, all the sweat equity, all the important decisions, and you just let VectorVest tell you exactly what to do. And it's more precise, it doesn't make mistakes, and there's a lot of key things that I just said there that can really go a long way to helping you be more successful in the stock market. And so when we start to get into the subject of when to sell, though, we're going to take a look at in this presentation at the investment climate and market timing once again, because while we got into market timing yesterday, anybody stick around for Dr. DeLito's presentation last night? Excellent. I know we had a big audience online too, which was great. He got into this last night, the investment climate, and that can have an impact on some of your decision making when signals are generated from a timing perspective. In other words, you should be far more fearful when you receive a confirmed down call when you're in a bear market or in the onset of a bear market than when you're in a thriving bull market scenario. Because stock markets, they don't just move up in a straight fashion all the time. They have bumps and wiggles and consolidations and pullbacks and corrections along the way, do they not? But if you're in a bull market situation where earnings are rising, there's a little less fear when those signals come in, because it's probably just a little correction period and gearing up for the next leg up in the market. So that's what we're going to get into here today and recap some of what Dr. DeLito did for us last night and cover some new ground as far as how you can look at a lot of the things we discussed within the program as well. Okay, so let's get into it. In summary from last night, we discussed that bull markets are born when the economy is weak, inflation and interest rates are low, and earnings are expected to rise. And so you learned that earnings are the key ingredient. Earnings, of course, has two enemies by way of inflation and interest. They're the bugaboos, so to speak. They're the enemy of earnings. And so there's this interplay between these three key elements. But this discovery is important in that the three factors that move the stock market around the globe, any market, doesn't matter what market you analyze, your main focus is on earnings. Earnings is the key. But having a little understanding of the picture on what's happening with interest rates and inflation gives you some clues as to what the effects are going to be on earnings, right? So bull markets are born when the economy is weak, inflation and interest rates are low, and earnings are expected to rise. The first inkling that investors have is that earnings are going to rise is when bull markets begin. Dr. DeLito talked last night about Citigroup. Citigroup was the culprit, or the catalyst. Catalyst is a far better word. Citigroup was the catalyst for the bull market that we're still in today. So they turned a profit first quarter of 2009. And so that's the key, is you want to keep your eye on these things. Bear markets are born, of course, when the economy is strong, when things are good. Life is roses, and inflation and interest rates are high and earnings are expected to fall. Eventually, interest rates become a problem as they continue to rise, just vis-a-vis the bull market scenario that you're in. And of course, inflation can run rampant. And Dr. DeLito talked about how those things can have a serious effect on earnings. Okay? So we monitor them very closely. We monitor them very closely in what we call the investment climate. The investment climate is like your 30,000-foot view of what's happening with the economy. Okay? In our climate section, we monitor earnings, inflation and interest rates, and some other market indicators in the section. So what I want Jim to do, we're going to do a couple of things here. The first thing that I want to do is, on the prior two slides, we really pointed out once again that earnings are the key. And so I want to give you a couple of resources that you can eyeball or take a look at in the program on a weekly basis. You don't need to get carried away and watch these types of indications on a daily basis. Week over week, every Friday, not a bad idea to take a look and see how earnings are performing across the global stock market. Make sense? So let's get in there and take a peek. We're going to go into VectorVest. All right, so where he's going to go, once we get the program loaded up here, we're going to take a look at at a couple of watch lists first, actually. We said keep your eye on earnings, right? So no better place than in the watch list section, actually. He's going to go to the Viewers tab at the top of the platform. And from the Viewers tab over on the left, you learned yesterday that there's a watch list section towards the bottom. And he's going to scroll down and find S&P. S&P watch list. And then as you scroll down through here, you should have all petro and no petro. See that? You've got an S&P 500, you've got an S&P 500 all petro and no petro. What I want to indicate here first is let's take a look at S&P 500. And when he clicks on S&P 500, you learned yesterday that's going to take a look at all the stocks on the S&P if you're willing to return them all. And at the bottom, you're going to have an average graph or an average row. It gives you the average relative value, relative safety, relative timing. And that in itself can give you an idea on the health of the stocks that are in the S&P. Okay? But what I want to show you is I think a little bit more important, and that's take a look at the visual picture of how things have been going and then therefore are likely to continue to go in the future. So what he's going to do is right-click the average row at the bottom and then view the watch list average graph. View the watch list average graph. And so, Jim, if you will, let's just do, say, a 5-year to kick things off. All right, now, the first correlation to discover is that earnings really is the key. It's the engine that drives the bus. It's the thing that lifts the stock market to higher prices. In particular, when you're looking at a window into the future on what earnings are going to be a year from now. So that's the first thing to try to get your head around, and it's not easy when you're brand new. But what I mean by that is if we start with these first data points on earnings per share all the way over here on the left-hand side, those are actually forward 1-year projections of where earnings should be based upon the trailing data for all the stocks and the 2 analyst forecast consensus numbers from Thomson Reuters. There's about 40 analysts that cover earnings and the forecasted earnings. So for example, if we're looking at EPS today, what we're going to look at is we're going to look at the year-end forecast for this year and the year-end forecast for next year, along with the trailing 12 months, and then extrapolate that vis-a-vis a formula to give you a 1-year lead. We're always marching towards the forecasts, but we're taking into consideration the trailing earnings performance. that gives you a better sort of likelihood of where things are actually going to be. Does that make sense? Any questions on that? Because that's an important point, okay? Yes?
So on that bottom EPS, you can't scroll more to the right to see where the projection is headed?
You can't scroll more to, so the question was, let's say the right-hand edge here, can you scroll forward more to see where it's going to be? This is the forward projection at the right-hand edge. So what that's saying is, if I look at this far right-hand, the far right-hand edge, right now the EPS is 533. That's where it should be a year from now. See what I mean? And so now, hopefully, this graphic will make even more sense. Because if we start back on the left-hand side again, if the forward 1 year projection is continuing to rise, what is likely to happen to the stocks in the stock market? See what I mean? You're not just tracking earnings performance as they present earnings information to you on a quarterly basis. You're looking at where earnings is heading. And so that's a very significant point. It's a very significant point to be made and to understand. And so when we take a look, we say and we talked about it last night, and I've done a special presentation on VectorVest University on the subject of climbing the wall of worry. Did anybody see that? That wasn't enough hands. That was the best presentation I ever made, I think. So you better go back and watch it. Okay? But, what do you think about the forward 1 year leading indication of where earnings is heading right now? It's good. In fact, it's accelerating up pretty nicely compared to anything that you've seen over the past 5 years. And so no longer do you need to worry about this barrage of things that are going to be attacking you via the news and other places telling you that, the market is ready to collapse. Now, having said that, there are circumstances that could head us in the other direction fairly quickly. So the key is perceived earnings. And Dr. DeLito covered that last night. It's the perception of earnings are still going to continue to rise. So all of this to say, yes, we're climbing the wall of worry, but you shouldn't be as worried as maybe you were before you got here. You always worry. Right? Most people do anyway. But you shouldn't be as worried as you were before you got here. Okay, things look pretty good and pretty strong. The interesting thing to do then might be to close this up and take a look at the all petro and then the no petro, because this will paint an even prettier picture. Wait till you look at the comparison and contrast between looking at just the petroleum stocks versus all the stocks that are not petroleum on the S&P 5. Incidentally, there are about 900 stocks, I believe, in the 7,600 that we track that deal with petroleum. It's a big industry, okay? In a number of ways. There's refinery and there's all different kinds of things. But what I'm going to have them do is just graph the watch list averages. So this is the all petro, correct, Jim?
Yes.
All right, so if he gives me the same 5 year, what do you think about the direction of the stocks and the direction of earnings across the petroleum industry? Do you see now why maybe even in VectorVest for a little while we started to get more concerned than maybe we should have, because it was really the petroleum stocks that were causing consternation in some of the numbers that we analyze. We were watching our earnings trend indicator come down and flirt with going below 1, and actually did for a little period of time. And we said, what's going on? Because as we went through earnings season after earnings season, semiconductors were on fire. All these different, 60-70% of companies are reporting growing their earnings. How is the ETI, the earnings trending indicator, heading underwater? It was really the petroleum stocks. Okay, so watch this. This is a 5 year look. You can see the stock performance, very, very choppy and ragged. And how much higher are the stocks today than they were 5 years ago? Almost nothing. Almost nothing. And so if we close this graph out and then take a look at the other list, eliminate the petroleum altogether from the S&P, and view the same 5-year watch list average graph, it'll paint a much different picture. Go to the 5-year. Is that eye-opening or what? So you eliminate one, albeit behemoth, group of stocks, and the picture is actually quite good. And that is the stock market, my friends, is really performing well in terms of earnings. It really is across the global market. It's just, again, the petroleum stocks that really came under a lot of pressure and a lot of strain. Okay? So that's important. And so I suggest it's not a bad idea to get in there and take a look at the No Petro from time to time. Now, I wish I should have stayed on the petroleum one a little bit longer, because what did you see? Does anybody remember? What did you see starting to happen now with the petroleum industry? The earnings were starting to go up. I got to be careful. I'm getting out of my little zone here. I have a tendency to be like all over the place. But you saw that the earnings were rising on the far right-hand edge, and so things are improving even in the petroleum industry right now. So things are actually looking quite good. Does that make sense? Did you see that visually? Do you understand it now? Excellent. Okay, so that's an important thing, and I would suggest getting in there at least once every couple of weeks, something like that. Get in here and take a look at those graphs, because you get a good picture on where earnings are headed. Okay, and remember, it's forecasted. It's a lead, so it's really telling the story. Okay? All right, so let's do this, Jim. Let's go back into the PowerPoint. Oh, I already got to the investment climate, did I? So I'll just remind everybody, it's not a bad reminder. In VectorVest, we monitor the investment climate, so we do all the work for you if you don't want to do the work. Okay? VectorVest monitors earnings, inflation, interest rates, and other indicators in the climate section. So we're going to go over to VectorVest, and I'm going to show you where you can find this information. Okay? So across the top of your platform, you'll have a tab up there called the Views. Remember, this is our daily investment newsletter. On a Friday, you get a more comprehensive newsletter. Monday through Thursday, you get the most critical data or information, which is timing and strategy. What's the timing look like, and what strategy should I implement based upon market direction? Okay? On a Friday, you get even more information, and one of the sections is the climate. So what I'm going to have Jim do is just go to the most recent Friday, which is yesterday. So he's there. Hello, Steve. And he's going to click the All button up here at the top and go to Climate. I did not sleep at a Holiday Inn Express last night. All right, let's come down here a little bit. I need to find where it talks about the case that we're in. So as he scrolls down the list here, you're going to get some good information on what's happening with all the things that we monitor in the climate section in the first paragraph. As you get to the second paragraph, it's going to say here our forecast of S&P 500 earnings rose $0.02 to $5.22. Its indicator remained unchanged at a level of 1.15. So we monitor the trend of the earnings in the stock market, and we put it on a 0 to 2 scale, as we like to do. And so above 1, do you think is favorable or unfavorable? It's favorable. Above 1's favorable, below 1 unfavorable. So as long as this number remains above 1, we say that you're still in a bull market scenario. It just becomes a question of, are you in where the bull market begins or ends, or somewhere in the middle? Does that make sense? Okay, so all you got to do is get a feel for it here, and we'll even tell you we currently have a case for bull market scenario in which earnings, inflation, and interest rates are rising, and that's the phase that the bull market ends, right? But it can go on years, for years and years. So that's good information there. We'll come back to that actually, because I'm going to introduce you again to the truth chart here in a moment. But now, if he scrolls down, you can see all the data. Okay? And so every Friday, we report all of this data in this table here. And what you're going to see is on the left, you can't see it, so I'm going to explain. The people at home probably can, okay? But some of you will struggle in the back of the room here. Maybe try to increase the size. See if it'll give us a bigger table. Okay, there you go. So you have maybe a little bit more, Jim. There we go. Okay? So you're going to have a couple of measures of inflation. You're going to have CPI and CRB, so leading and lagging inflation. Okay? You're going to have three measures of interest. Your 90-day T-bill, your 10-year, and your AAA bonds. Okay? And then you're also going to have earnings by way of the S&P 500. And so the next thing and some other things, we talked about other factors. You've got, percent bullish advisors, which can be a contrarian indicator. When everybody's bullish, that's the time to be fearful. Okay? But if we scroll back up, we then present the current level. Now, I'm sure everybody in here is an economist, and they know that a CPI inflation number of 2.2 is on the rise, right? You all knew that, didn't you? Why not? No, I'm kidding. I don't either, but I've got VectorVest, and all I need to do then is come out here to the right, and notice that it's going to march forward in time. So it gives you a little history here. And it says on 12/8, the number was 0.92, again on a scale of 0 to 2. So think of it in terms of when I look at the indicator and I look at the level, is it favorable to buy stocks? So inflation right now is saying it's not favorable. Okay? Now, because we have two measures of inflation, we actually take both numbers together and put it on a 0 to 4 scale. So we would add 0.92, you might need to show them this on the screen, 0.92 to 0.85, and that would be below 2 on a 0 to 4. See what I mean? Because there's two measures of inflation that we track. So when we get to interest rates, there's three measures. So it goes to a 0 to 6 scale. See what I'm saying? And then with earnings, there's only one key number, so that's easy. But that's just a little simple fact that you can keep your eye on. But that's how we arrive at earnings are rising, inflation and interest are also rising. Because when they rise, it becomes more unfavorable to buy stocks. You with me? But the net, the most important thing, all of that's good information. Some of you are really going to eat that up and love that. Others of you, all you got to do, guys, is just go down to the earnings number because that's the bottom line. Interest and inflation can start to become a problem, right? And more of a problem as we go. But not until they affect earnings does it matter. Oh, and by the way, hurricanes, assassinations, war, all this stuff, North Korea, all of that stuff can eventually have an impact on earnings, but it's not until they do that we care about them. Those are called events. Events can have consequences, but not until they do should we as investors worry about that. Okay? So when we go, this thing moves that. So when we go to the earnings number again, and we look at what direction earnings have been heading on the 0 to 2 scale, what direction is it? Up. So again, things are looking good, okay, on a current basis. Are we at a stage where the bull market began? Are we buying low at this time? Maybe, because you can buy low when stock prices are on the rise, right? So earnings is the key. But it's not going to be as easy now as it was in 2009. You with me? Okay. So that's how you frame this. That's the way we want you to try to think in terms of the macro investment climate and the impact that has on your decisions that you're going to make. All right. So the next thing that I want to show, in your books, if you're following along, I'm actually going to introduce you to the truth chart, not from the PowerPoint, but from the program. And I'll show you where you can find this resource and some commentary from Dr. DeLito himself around the subject of the truth chart. So what we're going to do, we can get there in a couple of ways. I happen to know every essay he's ever written and what date it was. Pretty close. Not really close, but I know the important ones, right? Because I teach this stuff all the time. So another way that you can go is there's this little search function over here on the left, and I could search for truth chart. I could have Jim type truth chart in there and search for it. Okay? And when he does that, when he clicks search views, you can select what sections and so on and so forth. You'll notice that we talk about it a number of times. I'm going to have him go all the way back to March the 21st. So we're going back to very early on, March the 21st of 2003. Sorry, Jim. I think it's the very first one. Isn't that cool? So that's where you want to start. When you research a subject, listen, if you want to learn about covered calls, search for covered calls. Go back. You'll be shocked. We've talked about covered calls, I venture to guess, 50, 60 times in the views. Okay? So it's interesting. At one time we were, and hopefully at some point we do, we were talking about taking all of these views and putting them into a book. It'd be the best book in the financial section of your library. You know? But he's going to click on the 21st. Double click it, I guess. All right, and then scroll down to where it says truth chart. I think it's the top of the essay. Okay? So here we are, and in here he'll talk about it, okay? And as Jim scrolls down, you'll have the table. This is the same table he presented last night, okay? Same table that's in your books. And so you'll notice again, in terms of the investment climate, we're monitoring earnings, inflation, interest rates, and then the resulting price action. We monitor the three factors and then the typical resulting price action on the market, okay? And so out to the far right, you'll see that we indicate what case you're in. The case number is on the far left and the actual description is on the far right. But you can see we're in a case one when earnings are up, inflation is up, and interest rates are down. They're trying to lower the interest rates to spur the economy. And at some point they accomplish that task, right? And so that's when bull markets begin. Bull markets thrive in the case two, which we often refer to, you'll hear us refer to as the Goldilocks scenario, okay? And that's when earnings are going up and inflation and interest are going down. That's the best of all worlds. Because earnings has the two enemies, right? Inflation and interest. So if they're going down, that's good for corporate earnings and it should only improve. When you have to start to worry is when you get into the bull market ends, and that's where earnings are up, inflation is up, and interest rates are up all at the same time. And you stay here, though, guys, for years. We've been in a case for, I'd have to go back and really look, but I'm going to say well more than 5 years, for sure. The case two, where the bull market thrives, doesn't last long, okay? And then, you spend most of your time here. So that's where we are today. We're in the case four. Now, the key takeaway here, I think the key takeaway and the most important thing, let me see how I'm doing. Okay, the key takeaway is, look at this. If I just focus on the earnings column and then the resulting price action, so skip over inflation and interest. If I just focus on earnings and prices, in every case that earnings are rising, what's the resulting price action? Up. In every case that earnings are down, trending lower, what's the resulting price action? Down. Okay? So earnings are the key. Earnings are the key. And remember, it's not only earnings, but it's perceived earnings. So the good news for you is we monitor the forecast and produce the lead. You with me? That keeps us on top of the perceived earnings number. If you're just looking at earnings today, it doesn't mean anything. So fortunately for you, you have a service that knows what they're doing and gives you the information that you need. All right, so let's go back into the PowerPoints here briefly. And so Dr. Delito talked at pretty good length last night, not only about the investment climate, but the resulting market climate graph. Okay, and so what we're looking at here is the same market climate graph that we discussed last night. On the top you have S&P earnings, and on the bottom you have S&P earnings VV. So on the climate graph, those would be the two selections. VV being the earnings trend indicator, okay? And so you also have, I forget to look back on the moving average. Can you remember, Jim?
I want to say 50.
I think it's 50. But what you have is a moving average of earnings up there, which gives you a pretty good clue on if earnings are trending higher overall, that kind of thing. The most important information is the bottom subgraph. That's where the rubber meets the road in this instance. The nice thing to see here, let me point this out. You see that big dip? That's where we were like, what the heck's going on? Because when you're looking at the market climate graph, you're looking at the entire S&P 5. So this was the petroleum effect. And we report on the investment climate every week. So as you imagine, we're saying, what the heck's going on here? And that's when we figured out the whole petroleum thing that I showed you earlier, okay? And so when you take those stocks out, what happens to this dip? It's not even there hardly, okay? And so, but just keep your eye on this number, and we will be keeping you abreast of those kinds of observations to make sure that you don't get tricked or deceived, right? We'll keep an eye on it. But if you look at what's happening to the ETI right now, it's approaching some of the highest levels it's been over this run. I mean, if we'd have to go back, this is a fairly short-term graph, but you'd have to go back to 2016 before you have a higher level than you see today. So that's pretty good. That's good news again. Now, so if we think about this, if we think about the fact that earnings are performing pretty well, let's say the market enters into a bit of consolidation where we are, enough to where you receive a confirmed down call. One of the things that we've learned over the years, and Jim will very, very clearly illustrate in situational investing a little bit later today, is that in bull market scenarios, the market corrections are very short and swift. So you predominantly want to think in terms of buying stocks in bull market scenarios. When you're in a case 1 through 4, you want to focus on buying stocks and the best opportunities to buy stocks. When you receive confirmed down calls, you then want to focus on protecting the profits that you've made after you've purchased them, okay? However, when this situation changes in the future and corporate earnings across the board, across the whole S&P are going lower and you receive a confirmed down, you have to be even more defensive. You have to think about the potential of going to cash or at least buying puts to 100% with a little cost to 100% protect the value of your portfolio. Jim's going to talk a lot about that this afternoon, actually. And so it's a very valuable part of our retirement services is the ability to protect your portfolio in those kinds of instances with puts and other things. But that's the way I want you to think about it in terms of how does the market climate have an impact on your tactical actions that you're going to take when signals are presented to you. And so one of the things that we can do here, let's go over into VectorVest here quick. Let's talk about, I have to go way back. Having said everything we've said so far, we've been in a bull market for a long time, right? And so I have to have Jim go way back to November 2nd, 2007. And I kind of let the cat out of the bag on this one yesterday, didn't I? But I was on a roll and I just couldn't stop myself, as tends to happen. But I don't mind showing you this twice because there'll be some people that watch the videos and may miss one or two, when they're kind of cherry-picking subjects. So the title of the essay, of course, was Contra ETFs, but in relation to this presentation, that's interesting from the perspective of we're telling everybody we can to do contra ETFs. And I can actually put a lot more flavor around this for you because I happen to be on yet another trip with Dr. DeLito at this time. We were in Orlando, Florida at the we were only several miles away from here. at the AAI convention. And we were telling everybody who would come by our booth that the bull market was coming to an end. And they looked at us like we were on the moon. We were Martians. They thought we were nuts. So this was back in November of 2007. The market had been in a bull market rally since March of 2003. So the market has been doing nothing but going up from March of 2003 all the way up into November of 2007, and we're trying to tell people a bear market's coming. Can you imagine what the reaction was? They said, okay. These guys are nuts, you know? But the reason we were able to say that, and the reason why all those people that walked away were subscribers a year later, right, was because we monitored the earnings trend. So scroll down here a little bit, and I'll read it again. So we're going to go to a word to new subscribers. The confirmed down signal we received yesterday could be the entree to a long bear market. We aren't there yet because earnings are still rising according to our method of analysis. Yet, we no longer appear to have the support of an accommodative Fed. You see, they said that they were going to continue or once again raise interest rates. And what's one of the enemies of earnings? Interest. Okay? And so that was the catalyst. That was the tipping point. Earnings by our method of analysis were already starting to falter. And so we wish we had a hotline up to the Fed and said, what are you doing, man? But, you know, what's that?
Did you get that yet?
Did I get it yet? No. I don't think we ever will, right? But we monitor it, and that's important because what then we're able to do is we're able to tell you things like, don't be deceived by the endless parade of experts who will appear on TV and other places telling you to buy stocks. This is not the time to buy stocks. You know, and so I venture to guess, again, aside from Prechter, nobody was telling you this information at that time. Okay? So valuable stuff, because let's go into the market timing graph, Jim. The point that I want to make here, you can do your daily graph this time. Let's just drag it. Just do all daily. I know it'll take a minute to load, but that's fine. I want to prove the point in a much better picture. And then what I'm going to have Jim do is I showed you the tech bubble yesterday. You remember that? Did that keep you out of harm's way when we said, it looks like we've seen the peak of that rally and we're heading into a bear market? Now we're talking about this one right here. Let's zoom into that. And by the way, that's the last true bear market that we've seen. We've had some correction since then, but this is the last true one. That would have saved you a lot of pain, right? And so I know a lot of people that became tried and true VectorVest subscribers because of that information. And it gets even better because at some point the stock market's going to stop going down and start going up again. And so Jim showed you yesterday, and I showed you as well, that on March the 6th we said the market is itching to rally. We absolutely, virtually nailed the absolute top and the absolute bottom of the market. And the best news yet is that's not the first time we did it. You saw we did it in the tech bubble. And we'll do it again. We'll do it again. And so that's why I stress the importance of reading the views, because when you stop reading the views and you disconnect, that's the only time I've ever gotten in trouble. When I think I know everything and don't have to start looking at all those numbers and look, that's when times get tough. Okay? This is important information. So I think where I want to head from here, Jim, is just back into the PowerPoint here, and let's tie a bow on it, because all of this creates an interesting phenomenon. Once again, we are still, the current situation, we're still in a case 4. But I've already mentioned, and we'll mention one last time, I promise, that we've been in it a long time. And so we're climbing the wall of worry, okay? So the outlook from here, though, is that this bull market will continue as long as it's perceived that earnings are rising. That perception should be quite strong right now. Because of what you saw with the EPS chart of the S&P and what you're even hearing on the street with forecasts being elevated more and more in the future. However, and this is the interesting phenomenon, even in spite of all that, we've come a long way. People have made a lot of money. People have made a ton of money from March. Some people have recovered the money that they lost, but others have made a lot of money from March of 2009 to now, right? And so they become fearful because I've got I've accrued all this capital. So at the very first inkling, that trouble may be on the horizon, they're panicking. Investors are panicking right now for no good reason in many cases. It says here, however, investors are looking for all kinds of reasons to sell, so stay alert. Consider put options in times of uncertainty or upcoming economic reports. Guys, just really quick. How many trade options? Not enough of you. That's what I was afraid of. So put option is very simple. It's like an insurance policy. You pay a little premium and you get some insurance on your portfolio. So you got to spend a little capital, but then you get full protection aside from the capital that you spend in essence. Okay? And so I ask you, is it worth a few bucks to protect your portfolio with insurance through times of turbulence or even situations like upcoming earnings reports? Because we just mentioned that we're climbing the wall of worry and people are getting fearful, and here's evidence of it. Has anybody ever heard of Ultra Clean? Yes. Okay. If you're a VectorVest subscriber, you should, this is a great stock, okay? Now, Ultra Clean, I think might have been the example I gave you yesterday. There are others. I probably should have put 2 or 3 in your book, okay? But Ultra Clean, look at the beautiful overall rising chart pattern. Now it's got some volatility to it, right? But look at this big gap down on the right-hand side, and then the resulting price action from there. It took a nasty hit. I mean, it wiped out all the gains from September overnight. See what I mean? And you want to know why? You want to know why that happened? Because they grew their earnings 60% year over year. But they missed the street estimate by 2 cents. That's the kind of stuff that you start to deal with when the bull market has been intact for a long time. You know, bull markets, this one's long in the tooth, to tell you the truth. They tend to last about 7 years on average, right? And we're beyond that already. So people are really starting to get fearful, and this is a classic example of that. So, does this slide mean a little bit more to you now? Because that can happen to anybody at this stage. It really can. You know, Ultra Clean's not a small little company. So stay alert, be vigilant, and Jim's really going to spend some more time with you teaching you that you're going to show the put. You're going to show how the put works and everything, right?
Yep, I am.
Yeah, so Jim's going to cover this subject very well for you in his presentation this afternoon, Worry-Free Investing, okay? It really is the only thing that can make it worry-free. But here's just another reminder. So you're going to say to yourself, all right, Steve, now you've scared me again. I didn't mean to do that. I'm just pointing out that it's wise to pick up some insurance. And if they beat and exceed and the stock goes up the next day, you just close the put, and you maybe lost a few cents or $1 or something, so be it. You know? You had the insurance in case things went the wrong way. But the inevitable next question is, when can I buy stocks again? Right? Can I buy stocks now? And so the color guard answers that question. Ray did a beautiful job covering the color guard yesterday, so I'm not going to spend all that much time. But one of the things that he showed you yesterday I thought was especially important in times like now. And that is, if we go over to VectorVest, hopefully you all know now that you can find the color guard right on the home page. I want you to notice the price column of the color guard once again. Ray covered this ground yesterday, but I'm going to recover it now, because if you want to know one of the smart decisions, the market's still been rising. It's been going up this week, right? We talk about the fact that there's a first green light and a last green light. There's always going to be a last one. Okay? So what I want you to focus on is you can continue to buy stocks as long as there's a blinking gold star in the price column. Okay? Otherwise, at this stage, because the markets have been on a nice little run again, you're taking a little bit too much risk. Okay? So look for that blinking gold star. Now, if the market hits into a correction, we have a nice little dip. Doesn't even have to be 10%. 10% constitutes a correction. But a nice little dip, and then the market starts to rise and you get a green light, don't wait for the gold star. You want to buy low and sell high. But one of the best ways to know now that the market is likely to continue to go higher is with the blinking gold star. Okay? Pretty cool, right? Yeah. Now you know all you need to know about when can I buy stocks Monday? Yes. But check the futures. Make sure everything still looks groovy before you put the order in. Okay? If you can. If you can't, you've done nothing wrong. You've done nothing wrong. So I've come full circle. What is the key thing to look for, guys, as we leave these doors and we go home and we've come to the seminar? What's the key thing to know when the party is coming to an end, when the bull market ends? You even got the word perceived right. I'm so glad you're here. When it's perceived that earnings are going to go down. Okay? And fortunately for you, we've always been able to identify that because we look at the forward earnings. Okay? And so again, right now everything looks pretty good.